Hello everyone. I would like to share with you an outlook on the markets from Bajaj Finserv AMC. When we look around the globe, we see large economies having problems of inflation, slowdown, and higher unemployment. India stands as a bright spot in this world scenario. Let me take you through some of the important data points. When we look at a large economy like China, most of the economic variables are pointing to a sharp slowdown. Whether you look at their retail consumption, their economic growth, their GDP growth, even their youth unemployment. The last time it was published, it was 21%, and then the government stopped publishing it. Already the Chinese government is working on a certain stimulus package to help revive the economic growth. The troubles in their property sector are increasing and now affecting their financial sector. Let's look at another large economy, the US. Rates continue to tighten and the Federal Reserve is still looking to hike rates. While people are expecting a soft landing, we definitely see a sharp slowdown. With interest rates being high, it has affected their commercial real estate market and also some of the small and mid-sized banks. The US downgrade of rating by Fitch has brought attention to the high debt to GDP and high fiscal deficit that the country is running. Let's look at Europe. Even there you are seeing sharp slowdown in growth, high inflation, and high interest rates. In many economies in Europe, you are seeing problems in the property side, on the real estate side, especially the commercial real estate segment. Even Japan is facing slowdown. After sharp currency depreciation and high inflation, it has affected their consumer spending. And last month export data shows that they are seeing contraction in their exports after 2 years. Unfortunately, there is not any good news from Russia or Latin America either. Russia, to protect its currency, overnight increased interest rates by 350 basis points from 8.5% to 12%. Argentina, 2 weeks back, in a single day, they saw their currency depreciate by 18%. In this gloomy scenario, India does shine. The economy is doing well. We are seeing upgrades in economic growth as well as earnings. Our banking and the financial sector is strong, seeing good credit growth, and asset quality is also healthy. Many economic parameters are pointing to a steady growth in India, whether you look at money supply, whether you look at inflation. Even when you look at the corporate earnings season this quarter, we've seen more upgrades than downgrades. The capex cycle in India is also doing well. The government is also spending on capex as well as the private sector. Yes, in this gloomy world, we would see some impact on our exports. India is connected to the world by 3 main points. The trade, which is imports and exports. The flows, which is FDI or foreign portfolio investor flows. And third, inflation or deflation. On the export side, this year we are likely to experience some slowdown. On the flows side, we may see some selling from foreign portfolio investors if there is a risk-off seen globally. On the inflation and the deflation side, I think we are managing well. There is some spike in food inflation in the last month, but we believe this will be short-lived. This is just a short-term issue. So overall, India is doing well. Indian markets, the equity markets, are trading at a multiple of 19 to 20 times on a 1-year forward basis versus the historical average of 17 times. Sometimes these averages hide more than they reveal. When we look at the price to earning ratio, we must also be cognizant that the underlying index has changed a lot over these last 10-12 years. Suppose 10 years back or 12 years back, the index had more cyclical stories, cyclical companies, or companies with high leverage or low return on capital, then even 17 times was a high number. Now that the index has seen more companies with structural long-term stories, with better cash flows and better return on capital, we need to take the average and adjust it upwards. So we don't believe Indian markets are expensive overall. Yes, there are pockets which have become expensive and there are opportunities in other segments. So when looking at valuations, we need to anchor and adjust. Anchor on the average, but also adjust for the change in constituents of the index. As Benjamin Graham said, in the short term, the markets are a voting machine, and in the long term, they are a weighing machine. This means that in the short term, markets are driven by flow and sentiment. If there is a risk-off seen globally, there could be some selling in the domestic markets also. But this provides an opportunity for long-term investors to add to their exposure in the equity markets in India. On the fixed income side, we believe that the rates will be steady around these levels. RBI has kept the regulated rates steady in the last policy. It has increased the forecast for the inflation by a few basis points. We believe this is in line with consensus, so all the data up till now is factored into the current prices. Going forward, the moves in the yields will be then data dependent. Thank you for joining us today and happy investing.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.